Good morning to everyone in the US and good afternoon to those in the UK and Europe. I'm Tamara Ecker, Managing Director of British American Business, and it's a pleasure to welcome you to day 2 of our annual Transatlantic Finance Forum. Yesterday, we heard direct from top business leaders like Jess Staley, CEO of Barclays, and Larry Fink, CEO of BlackRock. Today's sessions will be equally robust, with a focus on the future of US-UK trade and regulatory cooperation. We are thrilled to again welcome leading experts, including the US Undersecretary of the Treasury for International Affairs and the UK Economic Secretary to the Treasury later in the program. We plan to cover a lot of ground, so grab your coffee or tea as we are about to kick off. To introduce our first session of the day, I'm delighted to welcome Julio Jimenez, a tax principal at Marks Paneth and incredible supporter of this conference. Julio, over to you.
Welcome, everyone. My name is Julio Jimenez, a principal in the Tax Services Group of Marks Paneth, a proud sponsor of the BAB's Transatlantic Finance Forum. Since I began my career at the Department of Treasury, I've had extensive experience in international capital markets taxation. And as an international tax specialist, it is an honor for me to participate in this premier event where we can network with ourselves as well as discuss issues that impact our finance community across the pond. I personally invite you to join us on my panel entitled Financial Services Regulation, a chance to reset global standards, in which we will be discussing the future of financial services regulation between the US and the UK. We hope to help you identify issues so that you can mitigate risks and develop solutions in order to succeed. Thank you for joining us, and I sincerely hope that you take advantage of this wonderful opportunity.
Well, good morning, everybody, or good afternoon for those of you in the UK. And thank you very much, Julio, for that introduction. And welcome to day 2 of the British American Business Transatlantic Finance Forum 2020. Our first panel session today, as Julio said, is going to focus on financial services regulation, the current status of regulatory cooperation and coherence between the US and the UK, and the opportunities, challenges, and benefits of increased cooperation. I'm thrilled to say that with me to discuss these issues, we really have a dream panel of experts. Nausicaa Delfas is the Executive Director for International at the Financial Conduct Authority, the FCA, where she leads strategy for international engagement and manages the relationships with regulators and governments on these issues around the world. Welcome, Nausicaa. Suyash Paliwal is Director of the Office for International Affairs at the CFTC, the Commodity Futures Trading Commission, where he leads on international regulatory issues. Julio Jimenez, you've just met. He is a tax principal at Marks Paneth and an expert on international tax planning for multinational companies and particularly for the financial services community. Welcome, Julio. And finally, we have our very good friend, Catherine McGuinness, the policy chair at the City of London Corporation. She's also the deputy chair of the City UK and is co-chair of the newly formed British American Finance Alliance, a US-UK industry network of which British American Business is also a member. So welcome, everybody. It's great to have you all with us today. Just a reminder to our audience, you can comment on what you hear as we go through the next hour on the chat function, and you can send in questions, which I will put to the panel. So please, if you've got something that I haven't covered, or you'd like to dig in a little bit deeper on one of the issues that we've raised, please do let me know. So welcome, everybody. Before we get into the weeds of financial regulation, what I'd like to kick off with is just a general question about this extraordinary year that we've been through. I mean, clearly, the health crisis that has engulfed us over the last 9 months has been pretty devastating for some industries. And we know from our friends, unfortunately, in the legal profession that in some sectors, their bankruptcy practices have never been busier. But one of the striking things that when you look at the US and the UK particularly is the kind of robustness of the financial institutions and the general robustness of financial services. And maybe I'll come, Nausicaa, to you first, if I may. And I just wonder if you could kind of give us some sense as to why that is. I mean, is this basically an endorsement of the regulatory regimes that have been put in place over the last 10, 12 years since 2008? And can you give us some sense? Are you confident about this robustness will continue?
Thank you, Duncan, and thank you for the introduction. Very pleased to be here once again, though sad not to be in the States. So the COVID pandemic has been a really interesting exercise, actually, in looking at the importance of working constructively together across borders. You asked, first of all, whether the post-crisis reforms have helped in this scenario, and I think almost certainly, yes, they have, in the sense that markets have remained resilient overall. And I will come to the global aspect of this, because it is a global pandemic, and we have been working with our colleagues internationally to assess the impact on financial markets, and indeed to look at what we might need to do in the future if we discover that there are vulnerabilities. And at the outset, earlier this year, we coordinated really effectively, I feel, through IOSCO and through the Financial Stability Board with our US colleagues and others across the world to take a coordinated approach. And I think it's to a large part because of the globally coordinated nature of our public interventions that the financial system remained, in our view, resilient overall to the severe shock that was triggered. And now part of the response is to, as I say, continue to look at, well, how have the markets performed? Particularly, we're looking at the moment internationally on the impact on the non-bank finance market, both through IOSCO and the Financial Stability Board, and looking actually through data and analysis on how the markets performed and whether any regulatory intervention is needed to enhance them in the future, bearing in mind also that they're markets that are crucial to the recovery. So very interesting period. I agree, overall resilience, but we have to remain vigilant as the crisis is not over yet, and we need to continue our work in this area.
Yes, whilst there is some very positive news on the vaccine front, it does feel, and my discussions with people in our membership over the last few weeks, it does feel that the next 3 or 4 months might be a little bit grim until we get through to the spring. I mean, Suyash, could you add a US perspective on this? I mean, clearly there was I guess Dodd-Frank is now 10 years old. That was a response to 2008, 2009. Is it that package that has ensured that the US financial system has been as resilient as it's been?
Well, thank you very much, Duncan, and thank you to colleagues for this invitation to speak. I would definitely agree with what Nausicaa said. And in my mind, the 2008 financial crisis and this current year are sort of Act 1 and Act 2 in a way. That time, there was a much different regulatory landscape and a much different market landscape. And there was a huge global regulatory response, which was in many ways, of course, the right response at the time. But it led to a number of things. So for instance, in our space, in the clear derivative space, there was a clearing mandate. So you're going to have a lot more derivatives that are going to be cleared through central counterparties. As a consequence of that, going into the current year, of course, there were going to be some sizable margin calls to support that clearing system. And that raises the question of, well, were market participants sufficiently prepared for all of that? And what does that mean for the broader liquidity picture? And then, as Nausicaa was alluding to, in the banking sector and the financial intermediation sector, the post-2008 crisis reforms imposed a great deal of conservatism on the banking sector.
Yep.
And as a consequence, the non-bank sector stepped in to meet the demand for a lot of lending. Now, that was the picture we had coming into the current year. And of course, in the low rate environment, there was a good deal of activity there. And that led to a very different financial system going into the current year than we had, maybe 10 years ago or so. So I think, as Nausicaa said, it prompts just a good hard think about the system, what makes it up, what are the dynamics, knowing that this is the composition of the system, and what does that mean for us going forward to say, well, okay, this is going to be the nature of our system. If there is an event like what happened in March and April, what should the regulatory response be, and what kind of apparatus do we need? And the system did exhibit tremendous resiliency. We're, of course, very grateful for that, and that is a testament to the reforms. And it's just a question of where we are now and how we need to think about things going forward, I would say.
Yes, and Catherine, would you agree? Would you give high marks to the regulators for the response in after 2008-9? And I'd just also be curious about the industry's feeling about the sort of general government response over the last 8 months. I mean, the scale and speed of the fiscal and monetary intervention that happened both in the US and the UK, seems to get high marks from the senior executives in our membership. But just give us a sense of how you, taking a step back, and it's hard to, I know, when we're in the middle of this crisis. But can you give a sense of what's the drivers of the robustness of the financial system over the last 9 months?
Yeah, thank you very much, Duncan, and thanks also for inviting me. So let me take that in three parts. First of all, what have we seen with the aftermath of the 2008 post-2008 reforms? Yes, I think those really have held up very well, actually, and I think that we have seen that the focus people have put into resilience and the investment they've made since, and the regulations that came in, have shown a robust system which was well able to withstand the shocks that we've seen. And I would take my hat off to the regulators. We have a lot of contact with the US, just as a matter of course, because this relationship is extremely important to us. And from conversations I had even fairly early on in this crisis with senior US regulators at the Federal Reserve, at the SEC, at the CFTC, I got the clear message that that in fact Nausicaa has just reflected, that we heard of strong commitment to coordinating global regulatory responses to the pandemic, ongoing conversation to make sure that the markets were working safely and well. And I think it was good to see that. The investment that the sector put into new technology helped as well. And I think we've also seen a rapid response in the way that we've in the UK, for example, we've moved on in our expectations. I'm a lawyer when I have time to practice it, which is not in my current role, but we saw rapid moves in that area too, with wet electronic signatures or whatever being accepted by wet signatures in the past. I mean, that's only one little example. And we saw numerous ways in which the sector and regulators worked together to make sure that things carried on working. The sector was also critical in getting out the monumental support which the government has given to businesses and to individuals, the job support and so on. The sector was instrumental in getting a lot of that out to businesses. I think we would all say that the government did what it could in very difficult circumstances. What I'm hearing now is a real focus on when can we get more of the economy functioning again. Very difficult when lives obviously have to come first, but livelihoods matter enormously too. And we've seen a financial and professional services sector which has carried on remarkably well, has adapted tremendously well, but we see a lot of other businesses which are really struggling because they depend on footfall, or they provide services to office workers or tourists who are no longer there. And so we see a heavily indebted tranche of businesses across the UK, which the sector is going to need to come in and support into the future, working with government when we look at how to deal with this debt burden. So I think that is the next challenge for us. What do we do about recovery? What do we do about the heavy levels of indebtedness? What do we do about restoring the economy? And as we do that, what do we do about meeting some of the challenges that we still face with technology, with climate change, and so on?
Yeah, we work very closely, for example, with the airline industry and the hospitality industry, all of whom are members of BAB, and it's pretty gruesome, as you know. Before I come to Julio, and I'm going to just get a sense of what the corporates are saying, Catherine, if I may, what about hangover risk? I know there's some cases going through the court in the UK in the insurance sector. Is there a sizable risk in that space, do you think? Where do you, clearly with the scale of the crisis that we've had, it isn't all plain sailing. So there must be some hangover risk. And how would you characterize that from your perspective in London?
So, being a politician, I'm not going to answer exactly the question that you asked me. The first thing I would say, though, is I take my hat off to the regulators for bringing action quickly about that insurance position, so that we're getting clarity about the situation for policyholders, and I think that was a really positive step. I am concerned that the sector faces an ongoing reputational risk because however much work it has done to support getting support to support its customers, however much it's done to help getting government aid out there, it's inevitable that there will be businesses that won't make it very comfortably through this difficult period, and how we get across how we ensure that the sector does work appropriately in partnership with its customers, but at the same time doesn't carry the blame for the economic situation that we find ourselves in. I think that is going to be a challenge for us all. I think that is going to be a challenge for us going forward.
So thank you, Catherine. And Julio, I'd love to get a sense from you of what you're hearing from your clients. I mean, just about the general state of the balance sheets and the profitability that you're seeing, and any comments that you're hearing from your counterparties, the CFOs that you're speaking to, the Treasury managers, about the way that the US government has reacted to, and the US Treasury in particular has reacted to the crisis.
So the big thing that I think, the two things that have impacted from COVID, I think one of them has been introducing some new dynamics, and another one was a bit of a catalyst on old dynamics. And the new dynamics kind of trickled up through to the corporates, and that's location and people and digitalization. Folks were unable to travel, folks were locked into places, folks were working from one place where they're usually not. And that created a whole host of questions of, do I now have presence in this other country where I usually did not? Right. Do I have, am I engaged in the US trade or business because my employees from London happen to be in the United States and now have travel restrictions? Yeah. How do I deal with it vice versa? From the US perspective, there was some relief given in trying to tell folks, look, if you're caught here because of traveling or you're infected, it's not going to drag in your employer. Certain similar mirrored relief from the UK side, although in different types of flavor. But it kind of functioned as a catalyst for an overall issue that, putting COVID aside, was the digitalization of our economies and the world, and looking at tax rules that function in a world where we're in actual buildings and roads and cars and not, 4K HD cameras over the internet. I think in terms of the balance sheet and performance and how things have gone, the number one thing on the table whenever an economy slows down are debtors, and debtors unable to pay, debtors unable to perform, distressed debt issues and whatnot. The United States has a very particular approach for taxation of debt instruments and has very particular rules that sometimes are unforgiving in these downturns. It has certainly every time we're facing an economic hurdle like this, it speeds up the talk in Washington, D.C. about, do we have something or other that addresses how to tax these instruments in this climate?
Yeah.
Versus having a set rule that no matter what is happening, we look at it a particular way. I know that there's a bit more leeway of this across the pond there in London, but it did force a number of leaders, a number of front office in both the buy side and the sell side to kind of knock on DC's door and remind them, you know, we're facing with a number of these rules. It probably makes sense to deal with it one way or another. Another piece, of course, that, you know, we're all facing with in this dynamic is some form of economic stimulus. Whenever the government is then stepping in and trying to use some kind of policy to help bridge across. You know, it doesn't take much for most folks to look at a couple of pages of our news cycles to see what a wonderful circus some of those conversations have turned into in getting something viewed one way or another. You know, and one of the approaches, well, you know, fine, increase government borrowing, have a lot of stimulus spending and try to cover as much as possible, while the other one being, you know, we'll let the market run as it goes and whoever stands up can.
Yeah.
The US did offer financing in the form of particular loans to help folks throughout the area. And a lot of, you know, front offices were engaged in trying to figure out, you know, is this the kind of thing we should borrow from? And it was done in a loan type of context from the government, because if you were in a position to repay, you should. And if you weren't in a position to repay, there was some relief given to you in terms of forgiveness that wouldn't be counted against you or brought you into certain dynamics into the tax world. So a lot of CFOs and front office folks have been sitting there going, all right, how do we manage the impact from, you know, our credit products being impacted? And to what extent can we afloat that through government help, while at the same time realizing that if regulators weren't already, they are about to start thinking of the tax world a bit more, you know, less physical and more virtual.
Very good. So, and there's also the question of taking money is also one of kind of reputation as well, and there are big.
That is the thing that, you know,
there'll be a lot of stories about that.
Who was borrowing versus not borrowing? Was this public information? And, you know, a very minor Google search will let you know who was there and how. But I think the idea there was trying to not really bolster balance sheets and help capture performance directly. It was trying to help support your payroll, it was trying to help support your infrastructure, your administrative expenses while this was going on.
So I'm going to move, thank you, Julio, that was terrific. And what I'm going to do now is move back to Nausicaa, if I may, and just love to hear from you, Nausicaa, a little bit about how the UK sits regarding Brexit. We are 6 weeks away, I think, from the end of the transition period. I know you gave a very detailed speech a few days ago in London on city preparedness or UK preparedness for that. I don't expect you to reprise the whole of that speech, but I wonder if you could just give us the flavor. I mean, where do things stand in terms of adopting the regulations that will enable the city to largely continue to function if there is no agreement on January the 1st?
Yeah, absolutely. Well, as you know, as everyone will know from looking at the newspapers, the negotiations between the UK and the EU are ongoing. But an important point to, and that's a matter for the government and the European Commission. But regardless of where that agreement comes to, we shouldn't assume that it will cover all the issues in financial services. So we've been, as the FCA, we've advised the government on equivalence decisions, which it's for the government and the Commission to take. So far, there haven't been any equivalence decisions from the EU except for central counterparties. So we need to continue to prepare for all scenarios for the end of the transition period, which, as you say, is is only 6 weeks away. Now, the good news on that front is that overall, because of the preparations that the authorities have done in the UK and in industry, most of the risks to financial stability have been mitigated, and that's been reported in the Financial Policy Committee report. But the risks of market disruption are still there, and that's because whilst we've done everything we can in the UK to ensure continuity of business, so we have put in place a regulatory regime, updated all our rules. We've introduced a temporary permissions regime and a financial contract runoff regime so that business coming into the UK from the EU can continue smoothly. The EU hasn't got a similar arrangement. So for business going from the UK to the EU, it's a patchwork of solutions, and firms need to make sure that if they want to continue doing business in the EU, that they're complying with local law, it could be local member states law. So those are areas where when things are as detailed and complex as financial services, there's bound to be some disruption because of that. But vis-a-vis the US, we've done a lot of work with Suyash and the CFTC, the SEC, other US regulators to make sure that we're ready for the end of the transition period. So we've updated all our agreements so that business between the US and the UK can continue as before. Smoothly. And as I highlighted in my speech, in terms of the areas that sort of remain vis-a-vis sort of the UK and the EU, there are some outstanding issues, particularly with regard to servicing customers in the EU. Data, because the EU and the UK are doing data adequacy assessments which haven't been complete yet, so firms have to take into account and make arrangements for the transfer if they want to transfer data from the EU to the UK. And there's still an outstanding issue around derivative trading obligation, which we will continue to consider together with the EU to make sure that we come to a good conclusion. But overall, we've been doing everything we can to give as much certainty to market participants as possible. And you'll have seen recently the Chancellor announced some unilateral equivalence decisions that the UK is giving. And we, the FCA, have also announced our approach to the share trading obligation. So we're doing everything we can to give as much certainty to market participants as possible.
Yes, but I read your speech, and you advised all those market participants though to check and double check their arrangements.
Absolutely.
And there's no doubt going to be a huge amount of work going on in those compliance departments for companies that are doing business across the continent, across the EU. Suyash, I really, this isn't really the US's fight, but clearly there's a huge number of US financial institutions that have chosen to have significant presence in London for lots of reasons, as we know. Are you confident of where the sort of regulatory system lies at the moment as the UK counts down to January the 1st?
Well, I mean, first of all, just owing to the long-standing relationship we have with the UK and the positive relationship between the two nations and the two financial systems, and for systemic stability in general, we of course want to be good partners in smoothing the transition so that it is as seamless as possible. And I believe we've been taking steps going back perhaps a couple of years, and through that time have taken more and more steps to make the transition as smooth as possible. As Nausicaa was saying, updating memoranda of understanding so that transition happens smoothly, no action relief to provide for sort of temporary equivalence, as it were, until the UK's regime settles. And on the UK to EU movement, to the extent that happens, and no action relief to smoothen that so that does not prove to be a burdensome process. So it is a priority for us to be as helpful as possible for the system as a whole. And of course, as you say, we don't take a side in this, but we want to be helpful as partners in all of this. And not specifically Brexit related, but sort of towards the broader topic of supervisory cooperation, in addition to our great relationship with the FCA, and actually I would add the friendships that we have between the two teams and our staffs, we have a great relationship with the Bank of England, and recently have concluded, from the CFTC's standpoint, a new MOU for supervisory cooperation with regard to clearinghouses. So there are a number of things that are in train and happening, and as I say, we want to be good partners in this.
Well, and we'll come back specifically to US-UK financial regulatory cooperation in a moment. And I know, Catherine, you have to leave in a few minutes, but so I thought what I'd do is ask you to comment a little bit about sort of Brexit. I remember when we had this conference 18 months ago in one of these sessions, the comment, well, for UK financial institutions, Brexit has already happened, and so planning was well advanced, and the institutions didn't wait to get their ducks in a row. But any comments on that? And then, in your capacity as the co-chair of the British American Finance Alliance, I wonder if you could just sort of set the scene for us before you have to leave about what it is that the BAFA is advocating for in terms of US-UK cooperation.
Thank you very much for that. And I am sorry that I have to leave early, but we have a financial services bill with a parliamentary committee meeting today, and I'm going to speak to them. I'd probably rather stay here, to be perfectly honest. So yes, I mean, I think what the financial institutions have done right from the start is that they've hoped for the best and planned for the worst in terms of the outcome of the Brexit negotiations. So they've made what arrangements they needed to make, and they've been encouraged by our regulators in doing that, made what arrangements they need to make to ensure that they can serve their customers, whatever the outcome. There are a number of, a diminishing number of issues which they're not able to deal with themselves, which may be an issue if we leave without a deal at the end of the transition period. And there is also a question of whether people will have signed all the contracts that they need to sign to put new arrangements in place. And on that front, I am worried that some of the smaller customers and so on may still have a problem with paperwork and repapering contracts or signing up to new terms or whatever.
Isn't there a grace period? Did I read that correctly? Is there some sort of compliance grace period or not?
Well, you have to ask one of the experts, but no doubt there is time, but there's still an awful lot of work to do, and especially when you add to that the whole benchmarking question, which is going to generate work for people, and when you add to that, some of the issues. I won't go into details around the Lugano Convention, but there is an issue around legal contracts, which may mean that people need to sign up a lot. So I think there is still work for people to do. Mm-hmm. But I do think that the big institutions have taken all the steps they need to take in order to be ready on the 1st of January. It's very pleasing to see the announcements that our government has now made around our equivalence decisions. It signals an openness of the UK to international trade, and an openness which is characteristic, one of our characteristics, but which I think we need really to be building on for the future. So. And I would just say, as I say anywhere, we're still hoping and praying for a deal. We know that any deal that is struck at this 11th hour isn't going to do very much for our sector, nothing for our sector, but it will set a more harmonious basis on which to negotiate with our EU partners into the future. Because make no mistake, we're going to be negotiating with them, on and on. This is just the end of one chapter of that negotiation. Right. So it'd be easier to do it on the basis of a deal. In terms of UK-US relationship and the British American Finance Alliance, what we're really encouraging with that is two already very integrated, very positive trading relationships to become deeper. And we think that the free trade agreement that we're all hoping for will be one way of achieving that, but enhancing regulatory cooperation, taking the views of the sector into account on what the impediments to trade and to market access may be at the moment, it's absolutely the way forward. So I know that you've got my good friend and colleague Ken Benson speaking later on, I think. He's the co-chair on the US side, but we have produced a paper, and I will try before I leave, thank you, I think somebody already has, put the recommendations of our recently published paper into the chat bar. But really, it's around, we're suggesting a number of issues, and I think the bottom line is we would very much like to see the sector engaged in the Treasury to Treasury, the working group, the Financial Regulatory Working Group, so that the sector can contribute to how we can enhance trade, how we can meet particular opportunities such as the pace of tech, what do we do about data transfers, what do we do about cyber issues, and indeed how do we address issues around the whole ESG space. So a lot of opportunities here. Yeah.
Yes, I suppose, I mean, we could talk for a long time about the likelihood of a free trade agreement happening. We've been very close to that process, as you know, but you know, looking at the BAFA recommendations, I mean, is it your sense that an FTA is actually a requirement to get that done, or can a lot of that seems to me that a lot of the objectives of that you've outlined in that paper are possible with or without an FTA. Is that your perception?
Yeah, absolutely right, Duncan. This is what we're talking about here, in enhancements that could be made through other routes than an FTA. We'd love to see an FTA with an ambitious chapter covering, you know, financial services, but perhaps setting up a framework for a more structured dialogue on these issues rather than setting out the detail. You know, we would also like to see it ambitious in terms of data transfers and you know, digital issues. But what we're really talking about with the BAFA, we're really talking about other ways of enhancing that relationship and how the sector can feed into the regulator to regulator, the dialogue to look at how we can enhance trade through other means.
Well, look, I really appreciate you making the time today for joining us, and good luck with the committee. And I'm going to come now to Suyash, and I know that the regulators and the relevant Treasury personnel have been meeting regularly over the last couple of years before the UK officially left the EU in the beginning of January, under the auspices of the Financial and Regulatory Working Group. And I know there was a meeting, I think the third meeting, the third full meeting back in October. And I wonder, Suyash, if I read the sort of one pager that was the output from that meeting. But I wonder if you could just give us a little bit more kind of color on the discussions that have been going on in that group, and where you see that process.
Sure thing. So that working group is an excellent forum to enhance bilateral cooperation. I would just say at the outset that the cooperation and the relationship between the two nations and systems is already very strong. So it's a different tenor in that working group. It's just sort of friends speaking among friends about how to make a good relationship even better and take it to further levels of cooperation and integration. And so as you probably saw from the statements, it is a collection of the relevant banking and financial sector regulators. So on the US side, under Treasury's leadership, Federal Reserve, FDIC, OCC, CFTC, SEC, and each bring their relevant experts to talk about any of a range of topics. So this time, of course, the pandemic and its impact on the economy was a huge one. Innovation is a topic that's frequently discussed, and just broader cooperation between the two systems. And of course, as was alluded to a little bit earlier, benchmark transition is a sort of a topic that comes up, quite frequently. And I would just say that as you rightly point out, discussion had been taking place between the two sides for some time before, and really continues in many informal ways around and just totally separately from the working group. But the working group provides a great collecting mechanism to bring both sides together and the relevant counterparts on both sides in a way that promotes constructive dialogue. So I do see it going forward, and I hope that it goes forward, and I look forward to it because it is a good vehicle to smoothen transitions that are taking place and to, as I said, just continue a good relationship and make it even more and more collaborative.
Well, that's terrific. And Julio, I'm going to come to you in a moment about sort of the areas of dispute, I think, between the US and the UK and other areas on tax. But before I do that, Nausicaa, I know when I read that, the one pager of the output of the Financial Regulatory Working Group, I was struck by the fact that when it talks about the 5 themes that the group will focus on, the first theme was the economic response to the COVID crisis and the financial stability issues that potentially arise from that, which we started talking about today. Do you see this group as meeting more frequently and trying to provide guidance to both governments on the response to the crisis on a more kind of formalized, regular basis? Is that your expectation?
Duncan, were you directing that to me?
I was, Nausicaa, yes, sorry.
Suyash. Okay, sorry. Yes, well, as Suyash said, this was the 3rd Financial Regulatory Working Group. And I would second what he said, that actually it builds on our already strong relationship. With regard to specifically the COVID pandemic and the response to that, obviously we're continuing to speak bilaterally. You know, our markets are interconnected, but we also speak together at global standard setting fora, such as the Financial Stability Board and IOSCO, that are also considering these issues. So I would say that our relationship is continuing rather than periodic between the meetings, but the meetings are very helpful in drawing together all these important issues of common interest.
Terrific. Well, I'm going to come back to both of you in a minute on a couple of specific areas, both the regulation around sustainability and green finance and on innovation in finance. But before I do that, I'd like to come to Julio to just talk about tensions if they're in the sort of global tax system. I think, you know, we're aware, of course, of the sort of general discussions that have been going on about base erosion and profit shifting, which have been in the hands of the OECD for a period of time. That had particularly high focus as the UK and other European countries have introduced revenue taxes on digital companies, the so-called digital services tax. Just wonder how do you see this developing? This kind of the approach to international tax optimization and arbitrage that large companies look for as they look to optimize their tax position. Do you see this continuing in a world of ESG, where sort of doing the right thing, seems to be also very important for boards? How do people square that with tax optimization? I wonder if you could just give us a sense of how you think that's going to develop.
I think, if I get too philosophical, it always comes down to the basic problem of the only way to solve the issues of global taxation is with world government. And until we have world government with nice, neat apportionment and appropriation rules, we're always going to have some kind of gap or disparity. Because even in the OECD framework, there's always a bit of 2 steps, right? The governments agree under OECD principles, and then they go home to their own governing body to craft their own laws, their own rules. And that's kind of where the rubber meets the road, right? When in the global presence and talking, you have one attitude, but when you go home to see what can you actually legislate and regulate from your home country, you encounter other difficulties. In terms of the US and the UK and what's happening lately, I kind of view it in 3 dynamics, and while not necessarily created by COVID, definitely exacerbated by COVID. The first one is, the US-UK tax question when it comes to Brexit is, will there be able to retain accessibility to the US-UK tax treaty if you are relying on qualifications through another EU country? In other words, in order to meet the base erosion or in order to meet the limitation of benefits test, if I have an entity in the UK and I'm owned by somewhere else in the EU, we were offering some kind of reciprocity in that. We've currently had a deal to maintain the status quo, and so that, that's kind of there temporarily. But, a big question, as Catherine was putting forward and as Nausicaa has put forward, is, where is this going to land when 2021 comes around? Are we going to continue to play nice, or is that ability going to be lost? Does that mean from Her Majesty's revenue side, is there a position that, fine, you can no longer rely on being in an EU country to access that? And similarly, as I was mentioning to some folks before the call, our president-elect has kind of urged Boris and company over there across the pond to please have a deal for Brexit. And questions here have come up. If there is no deal, is that a position that the US would take to add pressure in saying we wouldn't recognize your presence in an EU country? In the financial universe, I think the sell side, the banks, the broker dealers, are pretty well established in dealing with that contingency. They normally have, some kind of substance in the UK. I think the institutional buy side, the asset managers, the investors, that kind of house, the private equity houses, they really do use more the UK as a vehicle. And so I really want you to think, Luxembourg coming to mind. There's a lot of asset management money. A lot of support is, anchored there, but going through the UK. And that has caused a lot of folks to rethink, what's going to happen when this comes through. Do we need to take apart this investment vehicle and this fund and reorganize, specifically into the UK, or try to find a way to pipeline wherever we actually have most of our investors? That conversation on the buy side has been going on for a bit. I use that as an example on Brexit, to kind of map out the entire OECD picture, right? And the tension in the OECD between the US and the UK is that still to this day, the United States has not signed up for the multilateral instrument that the OECD has put forth. And, even from my days at Treasury, it's a bit of a paradigm shift. The US tax policy has always been, one frame view. We don't care what another country characterizes an instrument or not. We have our rules to characterize a relationship, to characterize an entity, and that's what matters. That paradigm has slowly been shifting to where now we care about, hybridity rules, and our tax reform in 2017 kind of pioneered that. We now care about reciprocity and whether things are being taken into income in other countries. And we've always cared about our transfer pricing. The idea of BEPS and the OECD is a bit of a mirror of that. The point when BEPS was coming forth, their pillar one approach was really digitalization. Are the rules for taxation that are written for a brick and mortar approach of a universe really still worth standing? And, one point is, hey, if I have all these instruments between places that are giving deductions, but not having income and being able to give you a good position, how do we deal with that? So even though we haven't signed up to the multilateral instrument, the US has been passing laws that are, maybe some would argue, the first step in taking this, BEPS position in substance, and now BEPS is kind of following. Similarly with how do we treat payments come out and the digitalization of it. So I think what's happening still, our folks are lobbying and being in a bit of a waiting pattern.
Well,
we're still waiting to see, what does this translate when the actual jurisdictions take into place. But I think it's not news for anyone who's in attendance here from a tax side. A lot of the structuring that has changed. The universe of being able to use hybrid instruments, hybrid entities, leveraging off certain treaties, being able to use an internal capital structure with leverage in it is meeting its limitations. And similarly, arm's length pricing and transfer pricing is having a new front role in terms of, well, let's look more at profit splitting in certain dynamics and where people are, rather than a pure hypothetical arm's length standard, where would we come here?
Yeah, well, I think in one way or another, this is going to be there's going to be material here for topics throughout the next few years for really these kind of.
And the takeaway is to kind of stay a bit on top and stay informed, and always have, some creativity kicking in the back of your mind to be able to manage this, because as much as BEPS wants to change things, the tax principles are still there. Yeah. Those are still universal. There are still deductions for interest rates. There are still relationships and contracts that get categorized. And it's a matter of how far and elastic are the new laws going to be going with the progression of the OECD.
Fantastic, Julio. I really appreciate that summary of where we stand. And I know BAB has been, we understand the issues around digital services tax, but we still prefer a multilateral solution if one can be found. I'm going to turn to an issue that was raised throughout yesterday when we had discussions with Jez Staley of Barclays. We had Larry Fink from BlackRock join us yesterday, and a number of panel sessions. And this whole issue about sustainability and the way corporates and financial institutions will be judged and measured. And I guess maybe starting with you, Nausicaa, I'd love to get a sense from a regulator of whether this is this enormous trend towards some sort of judgment about a corporate sustainability and the investability of that company. Is that something that you feel will become part of the suite of regulations that national and international regulators look at, or is the market going to drive this?
Well, I think this absolutely is already here. The desire for investors to invest in sustainable investments sort of drives, perhaps the market drives this, or is driving this already. And from a regulatory perspective as well, both nationally and internationally, it's a priority for us. In the UK, we're looking at it from the perspective of issuers, ensuring that issuers provide markets with readily available, reliable and consistent information on their exposure to material climate change. We want regulated firms to integrate consideration of material climate change in their risk assessments, in their business risk and investment decisions. And we want consumers to have access to green and sustainable finance products and services that meet their needs and preferences. And they need to receive appropriate information and advice. So if we look at just disclosure, I mean, at present, there are hundreds of different disclosure standards in use in the industry, and climate change is a global issue. The regulatory response to climate change should also be a globally coordinated issue, because making disclosures that are difficult to compare, for example, is impossible from an investor's point of view. So we've strongly supported the effort to improve disclosures at international level. And the FCA is leading work to improve issuer disclosure standards within IOSCO, which is the global standard setting body for securities markets. And we're also engaging closely with other initiatives like the International Financial Reporting Standards Foundation and so forth. And you'll have seen in the UK, our Chancellor has made an announcement of mandating disclosures by 2025. And we are consulting on rules to encourage our most prominent listed companies to make better disclosures about how climate change affects their business. So
it's a mandatory disclosure on TCFD, is that right?
Yes, that's what we're moving towards, absolutely. And you'll see more from us in the coming year, particularly as the UK will be hosting COP26 next year on climate change. Yeah.
Well, that's fascinating, and Suyash, I mean, where does the US stand? I appreciate we're at a change of administration, or likely change of administration at the moment. So maybe kind of political will might change as well. But I just want a sense of how the regulators see kind of the momentum behind this, because the momentum is absolutely real. As I said, we had Larry Fink yesterday talking about his urging of corporates to adopt SASB, and the huge increase in companies that are doing that. I just wonder whether is this something you feel the market should take care of, or is it also an issue for regulators in the US?
Well, so you rightly pointed the kind of dichotomy between the regulatory response and thinking about it and the market side of it, and you're right to point out that the market has been growing in this regard for some time. The contingent of investors that seek out socially responsible, or that's antiquated terminology, ESG investment opportunities has been growing. And I think we are certainly hearing that from stakeholders. So as you might know, the CFTC has a number of advisory committees, and there's one called the Market Risk Advisory Committee, which has a subgroup dedicated to this topic, which has produced a fairly sizable report with a number of recommendations and feedback from stakeholders. And of course, in general, stakeholder input is tremendously important to the policy making. So on the regulatory side, there is already a principle of just risk management and ensuring the right risk management, disclosure of risks, and management of risks by different financial market participants. And it's a question of when the risks rise to the level that they need to be treated in the appropriate way within that framework. And I think that is a topic that continues to remain to be closely monitored.
And I suppose the same question really is around kind of general innovation in financial services. Obviously, there's been a huge amount of activity with new companies trying to find solutions for old problems to make financial services more efficient and so on. Suyash, I wonder if you had a comment on this. Is the regulatory environment, and we literally have 2 minutes, so is the regulatory environment set up to be friendly enough to innovative companies? Is there more that we could be doing?
I will keep my response brief. Yes. I think, yes, of course, the system is inviting, I think, to innovation, and there's a question of when you term it responsible innovation, which I think is the right way to think about it. There is more that always can be done for regulators to provide the right clarity of regulatory framework to innovators, so that innovators know how and when they can innovate. But in terms of being open to promoting innovation within the CFTC, we have an innovation hub that was just formalized over the course of this past year, the Labs CFTC, and we work with the SBA in the GFIN global project, and so we're participants in that. And it is a priority and continues to be a priority because innovation is going to continue, and it should.
And Nausicaa, final word: is the sandbox environment set to continue in the UK to allow companies to test products and ideas in a safe environment?
Yes, absolutely. We'll continue with our approaches, and indeed our international approaches. So we have a global financial innovation network where with partner regulators as well. So yes, absolutely.
Well, I'm going to now thank all of the panelists for a really terrific session. Thank you very much for joining us today. Nausicaa Delfas, Suyash Paliwal, and Julio Jimenez. I've certainly enjoyed the conversation. I hope everybody on the other end of the Zoom call has too. And thank you very much for joining us.